Hi, this is Jack Patrick. I'm going to put together a couple presentations. The first presentation is going to be talking about, in general, multifamily investing, my experience and what we do. Then we're going to be making a second video on the investing opportunity. We currently have, as of right now, December 2018, a 36 unit that we're looking to fund. I have a 24 unit that's going to be coming behind that shortly. Then we'll have hopefully a 60 unit that I'm looking at today, and we're looking at a 188 unit property. So we're just going to go over my bio, commonly asked questions, and also look at some case studies, some properties we've done. I live here in Strong's, Ohio with my wife Rachel. We've been married for 11 years. My daughter Emma, who's 10 years old, and my son Cole, he's 7. I started off initially as a firefighter for the city of Strongsville. Graduated from high school, and it seemed like a really cool career, and it really was. I had every intentions of taking that career all the way through retirement. But February of 2018, I took an early retirement, which really was a big decision. It was one of those decisions of like burning the boat. There's just no going back at that point. You have to be 31 years of age or younger to get hired on a fire department. I'm 38, so I left that career forever, and it was a career I really did enjoy. We had, the pay was good, and we had the best health care I'll ever see, most likely, a pension, and it was just a really, really good career. But ultimately, at the same time as I was a firefighter, I also started my real estate investing career. I started off in my early 20s by reading the book Rich Dad Poor Dad, and that was had a profound impact on me. We initially started building custom homes. We did that until the market crashed. At that point, we then transitioned to doing a lot of high-end remodels, and then also picking up single-family rental properties because it just made sense. The properties had got so cheap. We're able to buy a property for less than what the land cost. So we picked up a portfolio, started growing that, and really kind of deciding and figuring out what I enjoyed and what I wanted to do. My wife and I also started a nurse practitioner company back in 2010. We currently have 7 full-time NPs, and it's been a really, really amazing opportunity. When I left the fire department, a lot of the big driving decisions and forces on that were, if I would have not done that when I had got a little bit further on in my career and also in age, I would look back and regret not making that decision, and that was something that I couldn't do. And it was at that point, it was stalling me out from taking my investing to the next level. The other thing that I wanted to be able to do was just change the financial future for my family and creating legacy wealth. And I also wanted to be able to provide investing opportunities for my friends and family that they otherwise didn't have access to. In the book Rich Dad Poor Dad, they talk about, in our educational system, for the most part, we're taught nothing about investing. How to do it, rates of return, how to set up for retirement, how to make financially wise decisions. And that's something that is provided a very challenging road for a lot of people that are looking to get into retirement. Bank CDs that are paying 1.5% interest, mutual funds that are paying a relatively low interest rate, just are not able to sustain the people that I care and love for to be able to enter into retirement. So we want to be able to provide, first of all, an opportunity that provides a much higher return, but also doesn't put their capital at risk for like when we notice or get involved in another stock market crash, which ultimately we've all unfortunately have been involved in. So principles I invest with, a couple from Warren Buffett: never count on making a good sale. Have a purchase price so attractive that even a mediocre sale gives good results. So everything we buy at a wholesale price or a discounted price. We buy something on sale. So then we can make our repairs and improvements and be into that investment for less than what it's worth. Another thing is a risk comes from not knowing what you're doing. And I can say that I have learned a lot of very expensive lessons in the last 15 years. And it really has provided a great foundation for where I'm at today due to those lessons. I'm not going to call them mistakes, but call them expensive learning opportunities. There's a great quote that says, lessons cost money and good ones cost lots. Commonly asked questions about apartments. So apartments have been a proven low risk, high return investment for many decades. And that's very true. When we saw the housing market crash, apartments were not affected during that market crash because we've continued to have cash flow in those properties. Also, as people were getting foreclosed on and losing their homes, they needed to ultimately move into apartments. So it actually helped the occupancy levels of those properties. We look at a couple of generational gaps with millennials that are coming out of school with record high levels of debt that they either can't afford homeownership or they don't value it enough at that point to be able to purchase a home and make that financial commitment. So apartments are a logical place for them. Also with our senior citizens, as they get into a position where it's becoming too much to care for their home, it's a really affordable, easy option for them to be able to look into. Plus, people sometimes just have, just unfortunately situations that occur through divorce or bankruptcies where they at this point need a more affordable housing option, and home ownership does not make sense at that time. And again, apartments also fill that gap. We like commercial real estate because the deals are bigger. There's passive and residual income. At the time of refinance, any funds that come through that are tax-free. There's a long-term wealth building opportunity as each month our tenants are depositing rent, they are paying the mortgage down, and when we're buying properties in the right location, that we are seeing appreciation of the property through years as the value slightly increases each year. My team. So initially, when I started off, I did everything myself. At this point, I've been able to build out a team to be able to scale and grow this business. For my COO, I've got 2 gals that are helping out with my property management and assistant type work. I've got 2 members of my team that are taking care of acquisitions. And about a month and a half, we spent a lot of time contacting brokers. We reached out to over 2,500 brokers for deal flow. And we're also spending a lot of time, energy, and money as far as marketing directly to owners and creating planting all these seeds to be able to bring more deal flow in through the years. I've got a total of 5 guys that are running my rehab work. Caleb is running as my project manager. And then we actually just hired a 5th gentleman for handling all of our rehab work, rental turns, remodeling, and things of that nature. So the deals that we look to purchase are value add deals, meaning there's something that we can improve on the financials of the property. We're looking to buy properties that we're buying at a discount and have a deficiency. So we're looking for low rents, deferred maintenance, poor property management, burnt out landlords. And what we're looking to do is ultimately increase the net operating income of the property. So the 2 types of owners that we buy properties from are either mom and pop owners that have owned the property for many years. Typically the property is paid off, they're burnt out, and they have not kept up with the repairs and renovating. And because of that, they're not able to reach market rent until those repairs and updating are done. Oftentimes their marketing is typically just a sign in the front yard, whereas there's a lot of other efficient ways we're able to drive traffic to the property. The other, I guess, sellers that we buy from are very successful entrepreneurs, physicians, attorneys, dentists, doctors, business owners, where they purchase the asset, but their main means of making money are those other career options. And therefore, they take their attention off that property. And typically, they'll hire an inexperienced property manager. And at that point, it's just a downward cycle. There's a poor screening process for qualifying tenants, and they're bringing tenants into the property that are not qualified to be there, and there's a high rate of evictions. They're not taking care of repairs, or the owners are being overcharged for repairs. So once they get to a point where they're not making the income they need, there's a lot more money going back into the property that for needed repairs, and they start losing money. It becomes just a challenging cycle to maintain profitability. So oftentimes, and so many times that happens. There's a 180 unit building that we're looking at right now to purchase. And ultimately, they hired a property manager at $12 an hour with no experience, and other staff members at $10 an hour also with no experience. And because of that, the occupancy is low and just the property is in bad shape through mismanagement. So our goal is to buy a property where we will first initially look at all of our income and expenses and determine the value of the building. Because in commercial real estate, the value of the building is directly related to the net operating income that it produces. The more income that it produces, the higher the value of the building is. And that is not the case with residential real estate. So we're looking to increase income and decrease expenses. So to increase income, we're only going to be able to raise rents upon remodeling the property, the exterior, the common areas, and also the interior of the units. We're looking also to add or improve the efficiency of the laundry income. We're looking to add possibly like assigned parking fees, exterior storage options, interior storage options, and things of that nature. We're looking to decrease expenses by protesting the tax value at the county to lower the taxes, shopping for more competitive insurance bids, but without cutting coverage. We're looking to negotiate service contracts, like for garbage, snow plowing, grass cutting, laundry, things of that nature. We're looking to try to get more competitive pricing on that. We're also looking to save on utilities by decreasing our water and sewer usage by 30% with the program that we have. So we're increasing income, decreasing expenses, and what we're doing is we're actually forcing the appreciation of the value up by doing that. So as far as financial projections, funds are typically invested for about a 2-year period. We're paying a 10% fixed interest rate. We cannot say the word guaranteed investing. That's a no-no. So a $50,000 investment, just to put an idea to it, will earn about $416 a month of interest paid monthly. It comes out to about $5,000 a year. A $100,000 investment will earn $833 and change a month, or 4 cents short of $10,000 a year. Anybody that puts in $100,000 or higher will receive equity or a piece of ownership in the deal. I'm going to go into that further on the second video. Equity is really a game changer as far as looking at your investment. So, like for example, if we had to raise $400,000 for a property, which is one of the deals we're doing right now, I would carve out 10% ownership for that entire $400,000. That doesn't mean that somebody has to put in the entire amount, but if, for example, if we had 4 individuals that each wanted to put $100,000 each, that equity would be broken down into increments of 2.5%. 2.5% for $100,000, 2.5%, 2.5%, 2.5%, and then that would equal up to our 10% total investment. So the benefit of equity is you would still maintain the 10% interest while your money is in use. After 2 years, we've increased the net operating income of the property to a point we can now do a refinance of the property. The property is now worth more, so we're going to get a loan at a higher dollar amount. We're going to get a refinance cash out, and we're going to pay all of our investors off. So anybody that has an investment of less than $100,000 will receive all their money back, and they will be done with that investment. Anybody that has $100,000 or more into the deal will receive that piece of equity. So if there's any additional proceeds we get from the refinance cash out, they would get 2.5% of that, or 10% of it if they invested the entire total in. They would also get a portion of the monthly cash flow. They would also get a portion of any future refinances. And if we just decided just to pay the property off over 20 years and we then were to sell the property, they would also get a piece of the sale. Sources to invest in. So most often, most of my investors are investing through a self-directed IRA. There's a couple of companies, iPlan and Equity Trust, and there's many others, but in Northeast Ohio, those are the 2 larger companies. If you live out of state, then there's other options. I definitely have a preference with iPlan Group here locally. I feel that once the account is set up, that the paperwork and the process is a lot simpler. It takes about a month or so to set this up, but it allows you to be able to tap into your retirement funds that you don't have access to anyways, and be able to use that and deploy that capital into these investments without paying a withdrawal fee. It's about $500 to set up the account, and it's been the most common investment vehicle that we have used. Other times people invest with cash or money they have sitting on the sidelines. Sometimes investors have cashed out CDs and have used that capital. And we've also had people that have actually utilized a home equity line of credit. I would never suggest that for a high risk investment, because if the investment goes bad, you've lost that capital, and now you have another mortgage payment. But money is either working for us or it's working against us. Capital does not have a neutral position. So when somebody has a house that's paid off, that's a great accomplishment, but you then have that capital that's not doing anything. I would also make the argument that I have bought many houses through the years at substantial discounts because those properties have not been maintained and cared for. And because of that, we're buying those properties at a discount. So that ultimately was not a wise financial decision for those individuals. On the flip side, for individuals to keep their house at market rate as far as with the value, there's a lot of money that has to go into it for remodeling roofs, windows, kitchens, bathrooms, paint, carpet, flooring, and that's a money pit in itself. So having a lot of capital tied up into a single family house is not, it's great for the purpose of not having a payment, but from the eyes of investment, it makes a poor investment vehicle. So the biggest risk and how to mitigate those risks. So the biggest risk that you're going to have is the operator that you choose to work with, which in this case, I'm the operator, meaning I'm the one that's running the show, finding the deals, raising the capital, putting the plan in place, property management, remodeling. Their ethics, their morals are going to be the biggest piece of that equation. Their honesty and the trust that you have developed with that individual. And ultimately, I would really suggest to ultimately trust your gut feeling on that. There's a lot of people that have swindled people out of money. There was a financial advisor that stole the entire retirement of my wife's grandparents. They were smooth talking, but just trust your gut on that. The experience and track record of that person is going to have a profound impact on the success of the investment. How many years they've been doing it for? Have they been successful? And I would definitely check references. I would definitely check maybe past investors or current investors. It would also be worth doing a criminal background check and a credit score on that individual, just to have a bigger picture as far as that individual if you've never invested with them before. So when we were looking to secure the funds against the property through a note and mortgage, this is a document that basically it's a slimmed down version of the note and mortgage that you signed when you bought your own house. So this is the one way that we're looking to do to protect your investment. Again, I mentioned about a background check. If you haven't worked with somebody, this I think is definitely wise to do that. We reduce the risk of our investors by buying properties at a discount and then refinancing the capital out. And then we also utilize our team to really put a higher degree of management in place to really ensure that we're able to receive the cash flow that we're saying we're going to be. So I just want to present a couple case studies and then wrap this video up shortly. We purchased a 27-unit building in Dayton, Ohio called Green Forest Apartments. When we purchased the property, we had a gross income of about $70,000 a month. Occupancy was at 50%. And the purchase price was around, I think it was like $305 actually. So this property had a sewer line that broke off, and sewage had backed up into the lower apartment units. The tenants left, obviously. With the loss of income, the owners did not have the capital to put back into the property to remodel it. They didn't have the insurance coverage. And ultimately, we were able to buy the property at a substantial discount. We put in a substantial amount of money in renovations in the property. And we have increased the gross income to $170,000 a year. Occupancy right now is 100% with a waiting list because we now have the nicest property in the area. And we just had the property appraised and we refinanced, and we were able to reach a value of $725,000. And since then, we have actually increased the value of the building even further because we've continued remodeling and raising the rents in the property. So this is what the property looked like before. Definitely was in rough shape. But again, these are the deals that I really have a preference for. Not everything is in this type of shape, but we're only looking to buy a property where there's an opportunity to be able to raise the income and value of the building. This was a little extreme, but it was a great opportunity. Some additional before photos, and here are the after photos. So redid the hallways, flooring, repainted everything, and took care of all drywall repairs. And on the interior of the units, we extensively remodeled the properties. Kitchens, bathrooms, plumbing, electrical, flooring. We will not install carpeting in units anymore because they always become destroyed, and it's our largest expense when we turn over a unit is replacing carpet. So by putting luxury vinyl in, we're hardening the property so that if there is an accident or a mess for an animal or just a filthy tenant, we're able just to mop it up and the floor is good to go. Again, some additional photos here of the bathroom and the what the mailboxes look like at the moment. So my partner and I, we found the deal, we negotiated, we personally guaranteed the loan because we have to do that when the property's in that type of condition. We executed all the remodeling, the property management, we obtained the loan refinance, and we're also taking care of all the ongoing leasing and management. We did earn some capital back from the refinance process, but we ultimately put that capital back into the building, and our goal is to have every single unit fully remodeled, all the deferred maintenance, everything completely done, so then that becomes a passive asset at that point. But until we get to that point, it's going to be a couple of years of a substantial amount of work. And in this property, we created over $300,000 in equity. For our private lender, they were a passive investor. They didn't have any decisions in the property, managing it, babysitting it, watching it over, but they earned $41,000 and change in interest. This is another property we purchased right down the road called Salem Crown. The property is 27 units. It was owned by a physician who just did not have the time to manage the property. His office actually was directly in front. So the photos here are the worst units. The other units were occupied. The property was actually 90% occupied, but it was rough. It was very rough. Again, this is kind of a situation that occurs when owners just don't care about the property, as well as the property management is a poor decision. Just a few other before photos. We do have vaulted ceilings on the third floor, which we are now getting a pretty substantial premium with. This is what the property looks like after. So when we bought the property, rents were low. They were about $350 a unit, and we are now just reaching $600 per unit on the third floor with the vaulted ceilings. Average rent is about $550 in the lower units, and again, we're just reaching $600 on the upper units. But when you actually take the time to fully manage the property, remodel it, market the property, take care of the tenants, their needs, their requests, eliminate deferred maintenance on the property by providing remodeling, it's amazing how you can completely transform not only the value of the building, but also the class and the quality of tenants that we have in the property. A slumlord is going to attract poor tenants, not just financially, but just undesirable tenants. When you're able to provide a nice product, you're able to demand a higher rent, but also be a lot more picky with the tenants that you're bringing in. Again, just a few other photos. And that's going to conclude the video for right now. We're going to go into another video, which is going to go into the funding opportunity. If you guys have any questions, please reach out to me. My phone number, many of you already have it, but it's going to be 440-552-8483. Again, that's 440-552-8483.